just because somebody comes to the RIA and says real estate investing, real estate investing, don't get caught up in the trap. Understand what an investment really is and understand what your business is. Understand the difference between the two and run them accordingly.
All right, guys, here we go now. It is time to unlock more doors to deals. We're real estate investors here. We're real estate agents here, and we all have one thing in common. We believe that we can live the life of our purpose. We can create financial freedom. We can build a better life for those that we love, and we can live the life of our dreams. I don't care if you're trying to do your first deal or your 500th this year. You can get to the next level, and we're here to help. Welcome to Doors to Deals. I'm your host and founder, Jim Manning. Today's episode can be found on doorstodeals.com/018. And today we're going to interview a friend of mine by the name of Ron Phillips. Ron makes Ryan and I look like small potatoes. He actually does over 800 deals a year. And he even has his own podcast called the Get Real Podcast. He is a wealth of knowledge, and I'm really thrilled to be able to interview and share him with you all today. We've done a lot of business with Ron over the past couple of years, and I just really enjoy every time I can talk shop with the guy. I always get a tremendous amount of valuable information from him. And today what we're going to do is we're going to talk turnkey investing. And we're going to share a lot of valuable information, like what are thoughts versus doing rental investing versus flips. Why does it make sense for turnkey investors to buy properties at full retail value? Like what is the rationale and why is that a win for them? And there's a tremendous amount of other great things that we go through as well today. So anyway, let's get right into it. Mr. Ron Phillips, welcome, my friend. Welcome to our group, and really excited to have you. So just so you guys know, Ron and our company, I don't know what we've done. It's been like 20 or 30 turnkey deals over the last year or 18 months or whatever the heck it is.
Probably more than that.
More than. Okay, well, shows you what I know. I knew it was a few, but Ron is one of the best business minds that I know. I had the opportunity to listen to him speak a couple of months ago when he was talking about core values and some leadership principles that we're not necessarily going to get into today. But every time I can listen to this guy speak, I tune in, and I'm really, really excited that we were able to sweet talk you into kind of interviewing you on turnkeys and talking to the group and everything like that. So appreciate you, man.
Awesome. I'm happy to be here, man. This will be fun.
So, okay. So just kind of like, let's get to know you a little bit. So can you give us just a quick couple minutes on your background and kind of where you came from and what you're doing right now?
Yeah, sure. So I'm originally from Kansas City, just across the state from you guys. I guess most of you guys, I'm assuming everybody's in St. Louis area. I know a couple of people on here, so I know they are. But I'm from Kansas City. Went in the military when I was 17. Came back, took a bunch of sales jobs, got laid off at my last one. Answered an ad in the newspaper. That's how long ago it was. It was actually in the newspaper. Millionaire seeking real estate apprentice. So, and everybody now knows that is just a big cattle call for a pitch. But back in the day, most people didn't realize that there were these seminar things. I certainly didn't. I thought it was a job interview. Little did I know. And then I bought the I think it was a 3-day class, and I went to it, learned all about real estate, and loved it. This guy's pitch was that you do the work, find the deals, all that good stuff, and then he would fund it and you split it 50-50, which sounded like a great idea to me. So I submitted my first deal and they rejected it. And I was completely floored, man, because I basically put I put everything into this deal, and I had now been out of work for weeks and I have a young family and this was my money. Right. So after about a day of, woe is me, I just decided, you know what, the dude taught me how to do this thing. I'm just going to go see if this freaking real estate thing really works. So I went, I put this property under contract. And I did an option contract, and it was, I didn't have any money. So I didn't have anything for option consideration. So I told the lady that we would fix her ceiling was the reason that it wasn't selling was because she had a stain in her ceiling right as you walk in the door. I said, I will fix that as your option consideration. So we put that into the contract. Then I didn't know how to fix the ceiling. So I went to my brother and I said, dude, help me fix the ceiling. I'll split the deal with you. So we fixed the ceiling, sold the property, and in just under 30 days, I made just under 20 grand and never looked back.
That's awesome. So, and how many years ago was this again when you started out?
I was in 99, I think, 99 or 2000.
You're getting old, man.
20. I know, dude. I've been doing this for a long time. I've been doing this for a long time. Oh my gosh.
So when you're going through it, and we're going to really dive deep into turnkeys here. I'm just kind of curious because there are some, we have real experienced people on the call, but we also have a few new people too. Like when you're just getting going, what do you think like one of the most difficult obstacles was when you're earlier in your career about 20 years ago that you had to overcome?
Oh, I don't know, man. For me, it was that one day. It was that one day where I got punched in the sack, and I was just like, "What? This guy's not going to do what he said. I don't have any money. I don't know what I'm going to do now." And the thought crossed my mind: I need to go get a job because I'm done. I don't have anybody to fund these deals. And I think that's a big stumbling block for a lot of people because they think, as I did that day, like. And this is crazy because I was literally fresh out of training where they taught me, I don't know, countless ways to do deals creatively. And yet the first stumbling block I hit, I was ready to throw in the towel until I sat down and realized, wait a second now, there's another way to do this. And I think had that not worked, I might have thrown in the towel, man. I might have said, this dude screwed me, and then I would have been mad instead of successful. And so I think that it's getting past the first or second or 10th stumbling block, because after that, you know that it works and you have proof. And then after that, it's like, okay, well, I can do this. Now I'm confident. Now I'm going to go in and make this happen. I really think that is the biggest. And for me, it was a very short time. Right? It was only one day, but I've been in sales. I had knocked doors. I had done all of this stuff that's really hard, and I've had a whole bunch of rejection. So that piece of it wasn't really a problem, but the no money piece was a big deal to me. That's what made his system so appealing to me. I didn't have the money, and he did, right? But that was a big turning point for me because I realized I didn't need money to do these deals, and that very quickly I could have money. I mean, at $20,000 a clip, doesn't take very many deals to go zero to hero, right?
Absolutely. And I think the biggest difference with people that make it and people that don't are when you get to that obstacle, it's you kind of shut down and say, oh, well, this thing doesn't work, as opposed to Ron got to the obstacle and he asked himself the question, well, how can I be resourceful here? How do I solve this problem? What else do I need to do? And you just find a way around it, through it, underneath it, however you can. You just find a way to make it work.
And I think it's important because I think one of the main stumbling blocks for people is that they don't have a skill set that I already possessed, which was how to negotiate and how to sell. And in the sales industry, you are used to rejection and finding a way around. The whole sales process is finding a way around objections, right? And so when I got into that, that's what my mind naturally did. But it's because I'd been doing that for years. In addition to that, when I went in and talked to people, I had no fear of them rejecting me or saying no. And I already understood how to negotiate. So I had a big leg up going into this where I think a lot of people don't. Because if you don't know how to negotiate, you get into a house. I mean, that's a big deal, not knowing how to negotiate, right? And I think that's a big hole that's in a lot of the curriculum that's out there. They teach the nuts and bolts of how to do a deal, but the real deal is done in the negotiation, not in the tactical parts of how to structure it, right?
Yeah, and it's the good news though is it is a skill set that can be learned. It's not something that
Absolutely.
if you feel like you haven't done it before and you're not sure about it. I mean, it's a very learnable skill, and it's not as intimidating as you might think going into it, right? But
Absolutely.
okay, so let's kind of fast forward here because we actually just had a couple of weeks ago we had a whole hour on negotiation, so we'll just kind of move forward on that. But you're on absolutely right, man. I couldn't agree with you more on negotiations. So the so let's fast forward. When did you start getting into? Well, first off, what is turnkey? How do you define turnkey? And then,
Well,
like, when did you start getting
first
in?
off, we should probably state that I actually hate the word turnkey. I
Okay.
really do. I wish it had never been invented, but it is what it is, and what it means is that you're buying a property that's done, ready to go. Right? It's been renovated, or it's brand new construction. There's a tenant in place. There's a management company there. The company that's helping you with this has everything else that you could possibly need, and they make it super simple. And that is what we do. Now, I've been doing this since 2005. The word turnkey wasn't around back then. It was called a rental property. That's actually what it is. It's a rental property. And I think somebody came up with the term turnkey because then you don't get the negative connotations of the word rental property. But that's really what it is. And the problem that I have with the word turnkey is that it does take the negative connotation out, and people don't expect to have any challenges, which is that's just not the way rental properties work. Anybody who owns rental properties, or anybody who owns a property at all, knows that things happen with properties. I mean, that's just common sense. But for whatever reason, when you buy a turnkey property, those are supposed to just magically go away, and that's not really what happens.
So there's potentially an issue in the sales process of expectations kind of
Right.
not being in line with reality of hey, the turnkey provider, we're doing all the work, and there might be a vacancy. There might be
right. Your property may have something break. It might, like your house, it might happen, and you're going to have to fix that, and you're going to have a vacancy, and these things that should be taught just seem to be overlooked because the word turnkey makes it sound so easy. And legitimately, that's what we were doing in 2005. We were still making it easy for people. I just really don't like the term, but the turnkey process is a really good one. I mean, it's a fantastic strategy. I started doing this by accident in 2005. So my renovation business just got halted because we had some HUD mischief fraud in Kansas City, and HUD came and just put the city on lockdown. Man, you had to have a year on title to be able to sell to anybody with a HUD loan. And I was in inner city Kansas City, which in effect put me out of business. I was out of business, and so I got stuck with houses. I got thrown into the rental game, completely unaware of what was going on with how to run it. And so I very quickly changed my mentors to people who knew what they were doing in rental property, and then I found out that there's a whole bunch of people that want to do rental properties, but they don't have any conception of how to do it. They're scared of it. And there's this big niche that wasn't being filled. And I partnered with a guy in Kansas City. We sold a couple hundred homes to people on the West Coast. And then I just continued to open more and more and more areas and just grew. And we helped people buy rental properties all across the country. Been doing that since 2005.
So what do you think the biggest advantage with kind of selling these turnkey for yourself as opposed to just maybe like wholesaling a property or something like that? Like,
so you're asking what's the advantage to the investor that has the property?
Yeah. You get a house under contract. You're looking through exit strategies. Do I just wholesale it? Do I try and find an investor that wants a turnkey rental property? I'm struggling with using the word turnkey now because of your.
I know you just have to. I'm just trying to re-educate the population, Jim. That's all. I'm just trying to re-educate everybody. It's okay. We can call them turnkeys now because everybody on here knows that it's not free, and they don't. They're not just magic houses that don't do anything wrong. Anyway, I think that the biggest upside to it is that it's not quite a retail sale, but you can maximize your profitability. And if you're working with someone who can sell very, very quickly, you've constantly got an end buyer. So it's like having a wholesale list, except for you have kind of a retail list. So you go in and do a little bit of work to the properties, and you can really put that on autopilot, because turnkey companies like mine, we want a specific type of product. We're concerned with the big things. We're concerned with major mechanicals. We're concerned with the things that can really jack your house, right? And the return that you get from it. So you can easily go in and say, okay, I don't have to put this on the retail market, so I don't have to concern myself with, does it need granite or does it need, something else to compete in the rental and in the retail market. I can go in and do the exact same thing to every single house, and I know exactly what my costs are going to be. So it's something that can be easily scaled. And when you have a pool of end buyers, it makes it way more manageable of a process, because you're not trying to do every single thing yourself. All you're really doing is getting good at churning out that specific product, and by doing so, you can maximize your profits.
Yeah, and a little less risk than the kind of the retail market. So, as far as the market goes, like when we're in a little bit of a uncertain times right now with the economy, with what's going on with the virus and everything like that. So you've been doing this 20 years, so you've been through. All right, this will be probably a fourth cycle you've been through now at this point, right? As far as the buyer's market, seller's market, you name it. What have you seen within this turnkey niche? Does the niche actually become like even more desirable for people, like as the stock market becomes more uncertain, or like more people want to invest in real estate, or what have you seen in your career?
Yeah, so turnkey doesn't go away. That's the thing, and I've tried to educate all kinds of people about this. And some of the larger retail rehab kind of companies, I've tried to educate them on, look, the retail market actually does go away for a little bit. Once you get oversupply and go over the edge, the retail market is very difficult because it's a downward trend. So you're chasing a price point that's dropping. The market is shorting you every time you buy a house, right? And it's really hard to chase that dynamic on a retail side. But the turnkey market, it constantly buys. So you don't see, like in this COVID thing, we had 2 weeks of a pause where everybody was just trying to figure out what the hell happened. But other than that, people have been still buying because the returns are better than they can get anywhere else. There's no other place you can get returns as good, because there are 4 of them. So even if your property declines in value like it did in 2008 to 2012, it doesn't make any difference, because you're still getting double-digit cash-on-cash returns. You still have somebody paying down your debt. That debt return is somewhere between 3% and 5% your first year, and it goes up from there because you actually pay more debt every single year you own the property because of amortization. And then in addition to that, you get tax incentives, right? Which basically eliminates the need to pay taxes on your on the gain that on the cash flow that you're getting. And in some instances, if you are a real estate professional, it can offset the income that you're making from your real estate rehabs or flips or wholesale, whatever you're doing. So there's some massive reasons why a person would want to own this. And when you put all of those returns together, there isn't anything that does that produces the same return, and does so relatively passively. I mean, it's not completely passive, but it's still relatively passive. Somebody else can manage the property for you while you're continuing to do whatever it is you do on a daily basis to earn your money.
So what type of buyer list do you now have at this point? You have, like, across the nation, how many buyers do you think you have?
Thousands.
like literally thousands. So when you started getting ready to set this up, did you just find like one person? Like kind of walk me through the beginning of kind of like what you're doing with the turnkey, like how.
Yeah. So in the beginning, I worked
you-
with. In the beginning, I was the supplier. I didn't have any buyers, right? So I went out and I found a pool of buyers through someone else who was educating their clients. I became a supplier to them. And then what I did was I went out and, again, when I actually wasn't doing my rehabs anymore. I partnered up with a new construction company and I became the real estate broker between them. And I sold hundreds of properties for those guys. They worked really well for this other company. What I realized after doing that for a couple of years is that I needed to take control of the message that was being taught, because the message in 2006, 7, and 6 and 7 was psychotic. I mean, the people were teaching things that were just ludicrous, because I'm in a cash flow market in the Midwest, and they were teaching people to buy on speculation in the places that we all already know about now that got creamed in 2008. And that never worked. I mean, the math, if you just do simple calculations, that math never plays out. It doesn't work long term. It's like one of those credit card schemes where you just keep charging up credit cards and moving the balance. The balance is still there. At some point, you have to pay the thing off, right? And that's what they didn't get. So in 2007, I actually started to teach my own. So I actually marketed and started building my own list. Now I had carryover list from my dealings with all these other people, and that was the starting of my list. But after that, I really started to dive into building my own and teaching what I thought was the proper way to buy rental properties. And since then, now things are a little bit easier for me, but that's because I've been doing this for so long, because I have this large list and we keep adding organically every single month. We add more and more and more buyers. But in the beginning, it was really hard work. I ran 4 what you would kind of call RIA groups. They were, they weren't true RIAs because it was really just my stuff. But I marketed to get people into those meetings and constantly had those going. And it was a lot of work doing that.
And so really then you were just teaching them what the buying criteria should be, making sure that you're setting up the relationship for success. So why don't we talk about that? So buying criteria, what do you recommend on buying rentals when you're talking to people? What do you think?
Yeah, so A, B, and C class. We don't do any D, and I actually think there's an F class too. Especially in Kansas City and St. Louis, there's definitely an F class. You don't want to buy there. I only know this because I actually did buy there, and I got stuck with 13 houses in process in F area. You don't want to be in, and that's the area where you get shot routinely. D, you only get shot occasionally, and then there's C markets, which are safe. They're just kind of lower income, and B markets are pretty decent neighborhoods, but they're not the nicest homes. And then A are new construction, nice homes, nice areas. All 3 of those work, but all 3 of those have different, positives and negatives. And so we have properties in each one of those classes because all 3 of them will work. It just depends on what the buyer wants. We buy everything done. In other words, one of the main criteria is that we have all of the major mechanicals fixed, so that you've got a house that's not quite bulletproof, but it starts out as close to new construction as we can get an older home. And then, of course, new construction, which starts out new construction. That's the main thing. And then the biggest possible thing to make all of this work is solid property management. So you have to have solid property management to make this work. And if you do, and you do all the other stuff right, then it works. Now, as far as on a macro scale, how do we choose our markets? We choose them based on, first rule is cash flow. They have to positively cash flow. The more cash flow, the better. But the economics, the underlying economics in the city, have to be moving in the right direction, right? So let me give you, for instance, after the market crash in 2008, we moved into a few different markets. A lot of people moved into Vegas, and we didn't move into Vegas. And I'm not saying that's right or wrong. I'm just saying that in that time, the economics were horrible in Vegas, and people had to wait long time to be able to actually generate positive returns. And they bought houses really cheap, but I was buying houses really cheap in a whole bunch of other places that had underlying economics that were pretty good. Like we chose, instead of Vegas, we chose Boise, Idaho, because Boise, Idaho still had a solid infrastructure of businesses there. And they got creamed the same way, actually a little bit worse than Vegas did from a real estate perspective.
So let me slow you down here because this is fascinating. So tell me more about Boise, Idaho, solid economics. As far as a little bit more details on that.
So let me just kind of look at Vegas and then look at Detroit.
Okay. Yep.
Okay. Vegas and Detroit. The challenge is that Vegas, there's like one industry there. Detroit, there was one industry. When those horses got sick or shot, it was really rough. I mean, you can see that Detroit still hasn't quite recovered, and it's been over a decade. And that's because the car industry got obliterated for a while, right? And then, some of the car manufacturers moved, and Detroit got annihilated. Boise is a smaller market, but it has a diverse workforce. There's not one industry there. There's many industries there. So if one gets hit necessarily harder than another one, it doesn't destroy the economy of the entire city. Right? So take a look at St. Louis, take a look at Kansas City, Missouri, take a look at some of these other areas where you have a very diverse workforce. There's not one industry in St. Louis. There's not one industry in Kansas City whereby if it gets hit, the whole city is going to basically turn into a ghost town like Detroit, right? Some areas actually learned from that because in Florida, very quickly they pivoted. So one of our areas was in Florida. It very quickly pivoted, started to give tax incentives for companies to come there immediately following the crash. And so there were already green shoots in the economy showing that there were jobs coming that we could buy there. And within a year, there were going to be thousands of jobs, new jobs in that marketplace, right? Because the economy in Florida got wiped out too. I mean, it got hit really, really hard, especially the real estate market. So we were able to go into Florida, buy really, really cheap houses. As a matter of fact, $350,000 houses we were buying for $35,000 to $50,000. They were brand new, never lived in back in the day. It was the funnest thing ever, right? But we only bought specific areas where there was these green shoots of economic recovery because there were a lot of areas across the country that didn't have that. One of them in particular was Vegas. It took a long time for those green shoots to turn around. And by that time, when we would normally go in, real estate prices had gone up. So it wasn't ideal, right? So that's what we look for. And then when you move out of that kind of an economy, when you move out of that kind of, and you recover and you start on the way up, well, then it's all a numbers game at that point. We're still looking at the economics to make sure they're going in the right direction. But at this point, now it becomes financial. All of the markets cash flowed in 2008, 2009, 2010. I mean, it was easy because the houses were so cheap. Anything would cash flow, right? So I could make Boise, Vegas, Phoenix. I could make all of these things cash flow. Well, after 2013, you couldn't. Prices had gone up in those markets. Rents didn't. And because of that, now it affected the cash flow numbers. So we move back into safe markets, which are usually Midwest, South, and East. Those markets just typically cash flow all the time because the prices don't rise crazy, and rents, they track basically with it, or maybe just a little bit north of it, of house prices. And so because of that, they continually produce really, really solid cash on cash returns.
Okay, so then
that's where we are now, right? We're in all of these markets. You know, that's why we do business with you guys, is because, well, I mean, the cash flow numbers still work really, really well. I can't compare that to Phoenix right now. It doesn't work. Can't compare it to Boise, Utah, none of those places.
So, what is it? So, as far as the cash flow goes, what return are you trying to get your end turnkey buyers?
Cash on cash return, we're trying to get double digits, and the higher the double digits, the better. Now, that all depends on the property too, right? So you can't compare an A class property to a C class property and expect the returns are going to be the same. They're not. There's significantly higher returns cash on cash when you're talking about a C class property, but there's inherent challenges with a C class property that you don't have with an A class property, right? So you give up a little bit to move into a new construction A class property in your return, but you don't have as many problems with it. Things got a builder warranty from day one. Everything's new. It's you're just not going to have as many challenges, right, as you will with potentially with a C class property.
So really, I mean, so as far as the name of the game for you is really you're matching the end buyer, the turnkey buyer. I keep like laughing in my head now every time I say the word.
I hope everybody does. Let's just spread the word, guys. Spread the word.
Let's call it the landlord. So the end landlord to the supplier. So in this case, we're the supplier on the end. So we're Three Doors Properties when we open up this call with, hey, we've done 30 deals or whatever together. So we're finding it. We're doing the construction, you name it, kind of getting everything in place. And you really are, in essence, supplying the end buyer and kind of connecting and making a profit that way. So what do you see your typical investors like looking for? Like as far as their cash on, like, let's say it's a C level property. Hey guys, just wanted to let you know that we're launching a free Facebook group to continue the conversation about this episode or really anything and everything else that's on your mind. We're calling it Doors to Deals, and we'll have access to the to the Facebook group on our website, doorstodeals.com. You can also find it on Facebook as well. Doors to Deals is the name of the Facebook group. So if you want to continue the conversation, connect and meet people and help us launch this thing, please join the group. I'd love to have you on it, and look forward to kind of seeing you online on Facebook. Thanks, guys. What do you see your typical investors like looking for? Like as far as their cash on, like, let's say it's a C level property.
Yeah. So most of them hover somewhere between 16 and 22% cash on cash return. And it really depends on the market. We're in 8 states. So, we have a really good view of what those properties look like in each one of those states. That's a pretty decent range. New construction, you're probably somewhere between just north of 10%, like 10.5. And, we've had them as high as 14, which is actually really high. Anywhere between 12 and 14% new construction blows off the shelves. And then, B is going to be in between the two of those. And if I'm in your shoes, everybody who's on this call thinking about selling to a turnkey provider, everybody's like, well, what should I price the property? I mean, where do I have to be to be able to compete? Well, I said, well, just depends on how quickly you want your property to move. If you put it at the top end of the scale of what we currently have in inventory, it's going to sell fast, right? And if you do that, then you're turning your money quicker. And if you're smart in business and you understand how money works, you can give up just a little bit for a quicker money turn because you're paying less in cost, and you're also able to get a little bit more velocity on your money and get more and more deals churning through the system. But a lot of people don't understand that. They don't get it. So they try to maximize their pricing on one property instead of taking just a little bit less and doing 5 of those same properties faster, right? And it's the same thing with the new construction. Like we have to educate the builders about, look, we can bring you 20% more business next year, but we can't bring it to you at a retail price. You're going to have to come down just a little bit to make the numbers work, and then we can pre-sell them for you, right? So there's an education process that usually has to happen about the velocity of money and what happens when you can do more deals faster.
So when you, so take me through the process of I have a property. I'm like a real linear thinker, so let's just go through this. So I have a property. Okay, I've decided I want this to be turnkey. Um, and then I contact Ron's company, then what happens? Kind of walk me through your process. And I say, hey, I have
Well,
this property. I think one of your investors may want to buy turnkey.
well, first off, we don't work with people who have one property.
Okay.
Because that's a pain in the butt for me, right? But there probably are guys out there who do, and you should use them to help you get to the point where you can work with a larger turnkey provider, because we don't go away when the smaller guys actually do go away sometimes in market cycles. So there's a way to no, and then there's another way into that, right? Because 3 doors is a big. You guys are all a part of a bigger company, which most individual investors aren't. So when an individual investor calls my company and says, hey, I've got a property I think will work for you guys, and I say, well, how many can you bring me? And they go like 3 a year. That's not worth it to me to vet them and make sure that they're going to do the process all right. It's just not worth it for our time, right? We have to have somebody who can supply a larger number that makes it worth our while to vet them properly and go through setting up all of the structure. Okay, so that said, how does this work? Well, it's really simple. Once everything is set up, we have a software system where you can just upload the properties. It's very simple. On your side of the software, you can put it in there and you can play around with the numbers inside the system before you submit it. So you can try to maximize how you want your returns to be and how you want them to look based on the rest of our inventory that you can see. So you can price it based on how you want, and then you put it in there. Okay. When it uploads, it goes into my my system on our side, notifies our system, and then we go in there and we make sure we have everything that we need. We check the numbers, and then we hit submit. It goes to the sales team, and it's up for sale. Prior to that, how to get into the system, we just sit down with you and go through what we expect a turnkey property to be, and I've talked at a high level of what that is, but we need the property to be done, and then we go through the process, and we have a seller document of things that we expect from our sellers. Like we expect a warranty, we expect an inspection, and a lot of our guys will get to the point when we start doing a lot of deals, they'll just order the inspection up front. It'll be nasty, but they'll just order it, and then they fix everything on it. And then it's super simple, right? We have an inspection report that's done. We already know everything's been taken care of. It's by a third party, so we don't have to trust that. Our buyers don't have to trust the supplier, and that makes things work really, really fast in the process, right?
So the warranty, the inspection, just like the work is done, it's it's turnkey. There's that word again. It's turnkey.
It is.
It's end buyer. And really,
they're getting a product that they know has been inspected and that everything in the inspection report has been taken care of, and they're getting something that with a tenant in place that's just it's ready to go. When they close on it, they're going to start cash flowing. And it makes new investors feel really confident because the property is already cash flowing. They don't have a payment for 30 to 45 days and they're getting income already. That's a really good feeling when you're a new investor and you've put your money into something, because the stock market doesn't do that, right? It doesn't send you a check, unless you get a dividend producing stock, and then you don't get any growth. Basically, you get all your growth you get in the form of a dividend that you get taxed out the wazoo for, right?
And you put the onus on the supplier to really have the property management kind of set up for it as well, don't you? What's your
Not
process?
Necessarily. A lot of them do already have contacts with property management companies. But for instance, in some of our areas, we work with 3 or 4 different suppliers, and we have one management company, because if we had 4 in one area, it gets to be confusing for our clients, And so in areas where we have multiple suppliers, like we may have new construction and we may have 2 different rehab companies that send us deals, all 3 of those use the same property management company. And so it's not necessarily always on them. You guys, in particular, just happened to have relationship with a good property management company, so we used them. If we added another supplier in St. Louis, we would probably still use the same management company because otherwise it gets really confusing. Imagine owning 5 properties in St. Louis and you have 3 different property management companies. That's just a pain in the butt.
Absolutely. So, that makes total sense because you're an end investor is not going to want that, different statements and all that.
Exactly.
That's going to get really confusing. So I'm trying to think through. So if you all like listening to this kind of want to start doing some turnkey deals and things like that, we can help with this process. You can we can help connect and do some deals together on those. So just a heads up there, guys. Even if you're on the smaller scale, we can work together on that. And I guess one of the big benefits too is we hit on this a little bit earlier, but having that end buyer and then being able to, these turnkey buyers a lot of times will buy things. What do you think, about 90% of appraisal or so, like of appraised value? Do you know where that typically comes in at, Ron? Like, do you have any stats?
And which for the investors on the call is probably, they're like, I would never do that. Well, there's a big difference between you guys and your average, rental property investor. They don't have the time and they don't have all of the resources to be able to go out and find properties at 60 to 70 cents on the dollar, right? So 90 to 95% of market value is a good deal for them, because otherwise, what do they have to do? They go on the MLS and they pay retail, right? So, and then they have to do everything on their own. So where they can get something that's done, basically done, ready to go, and they're paying a little bit less than market value, that's a great deal for them, So it's funny when I'm educating actual real estate investors who are really good at negotiating and getting good deals, and they have all of the systems in place to be able to do that. They think this is psychotic, but it's not. I mean, look how many people are on the call, and look how many people are in St. Louis actually doing deals on a normal basis. That's their business, doing deals. It's really not that many. When you go to a RIA club, there may be hundreds of people in the room, but there's a fraction of those people who are actually doing deals, really, really doing deals, right? And so it's a very small, tight-knit group of people who have the skill set and the mechanism to be able to actually make this work. So to provide something for the end buyer as an investment where the numbers work, that's a no-brainer for my type of investors.
Yeah, and I mean, if you think about the time play, guys, like if I'm like an oral surgeon, and I don't know what oral surgeons make, 300,000 a year or whatever the heck it is. I'm just making something up. That's probably going to be wrong. Glad we're recording this.
It's on the low side, yeah.
On the low side, so let's say 300,000, and they are taking a pay cut by trying to be a full-time investor. They might as well just go out and remove some more wisdom teeth with the time. But when you're making that type of income, 90% of all millionaires own investment real estate. And when you're making that type of income, diversifying into something that's not just the stock market makes a tremendous amount of sense. So this is an amazing play for people that are affluent to be able to get all these benefits that we talked about earlier, the tax benefits, you name it, in a way that doesn't cause them to create another part-time or full-time job on top of what they're already doing, right?
Well, let's be clear. One of the aha moments when I got into rental properties was the fact that I thought beforehand I was a real estate investor. We all call ourselves real estate investors when in reality, unless you're buying an asset and keeping the asset, it's not an investment. It's not an investment, right? That's your widget that you sell. You are in a business. You've created a business. And it's not unlike the oral surgeon. So what you guys do for your day job or your day company, right, your day business, it's not all that much different than the oral surgeon. They do what they do to make their money, and then they invest it. And if you guys, all of us, are wise, we do the same thing. Because when you guys renovate a house or you wholesale a house, you get money because you've sold your widget. It isn't any different than when the dentist or the oral surgeon sells the surgery. That's their widget. They make money for that. What we do with that money after that is the investment part, right? We either spend it, therefore not invest it, or we invest it so that we can continue to spend the money that it's spun off. So let's not all fool ourselves into thinking that what we do on a daily basis is an investment. It's not. It's a business, right? So we all call ourselves real estate investors because that's what the vernacular is. But the reality of the situation is that all of us on here are business owners, and that business cranks out revenue no different than any other business. What we choose to do with the revenue is what makes the difference. Now, you guys just have the ability to buy properties for your investments at 60 to 70 cents on the dollar, which is fantastic, you know. But unless you buy them and hold them and keep them for passive income or rental income, well, you're really not an investor. You're a business owner that makes a really good money.
Wow, that's I'm a little speechless here, buddy. I'm like listening to you. I have not thought about it that way, but yeah, I mean, it's absolutely 110% correct. And one of the biggest mistakes that I made earlier in my career is I told myself I didn't have enough resources back in 2008, 2009 to start buying rental properties because I didn't have enough money. I was looking on the MLS and seeing all these cash flowing properties that I could buy. And I thought, well, I don't have enough money. And unfortunately, is looking back, what I realize now is that I could have been more resourceful. I could have found someone that had money.
Yep.
So when you look at my investing career, much more flipping, much more wholesaling, helping people as an agent, you name it. And the long-term wealth, while we have a rental portfolio that's doing well, we could have generated a far more amount of wealth, had we been actively investing throughout the years, and starting in 2008
Yep.
when we got cranking.
Yeah. So everybody, don't do what Jim and I did, because back in the day, 2008 to 2012. I didn't buy anything. I sold everything because it was so there was such a voracious appetite out there to buy properties. There weren't enough properties for me to supply to my people. So instead of me taking some of those for myself, which would have been really wise, I didn't do that. I sold them all to my people. And now I'm helping all of those people 1031 exchange hundreds of thousands of dollars into other rental properties. And I didn't keep any. All those properties I bought for $35,000 that were $350,000 before, and the rents were like $900. All of them, I sold all of them. I sold every one of them, like an idiot. So don't, just because somebody comes to the RIA and says real estate investing, real estate investing, don't get caught up in the trap. Understand what an investment really is, and understand what your business is. Understand the difference between the two, and run them accordingly.
So Ron, what's your personal investment portfolio look like? Do you have anything right now, or are you more light on that?
Yes, actually I do. So I own apartment buildings, and I own single family homes, and I own a commercial building, which I would sell right now if anybody wants to buy it. It's in Kansas City. Great.
Is that because it's in KC, or like what's?
No, it's just because it doesn't fit my portfolio, right? I don't understand the commercial, and I can't stand commercial real estate brokers. They're the most entitled bunch I've ever seen in my life. So they want to get paid a mint on everything, literally everything. I don't understand how anybody makes any money in commercial real estate except for the brokers. They make a potload of money. So if you're going to be a real estate broker or agent, you should do commercial because they make a ton of money. And, well, in my opinion, don't do a whole lot.
They want you to think they do. No,
right.
I don't. I don't. We have a commercial building too that we're kind of in the process. I mean, the one thing I would tell you with commercial is Ryan and I are not personally doing a great job with the building because we're focused on all this other stuff that we have going on. And I mean, you really if you're going to go that route, you really need to pay attention to it and put a lot of time and effort into it for sure. It takes a lot more time than you think it should when you buy the building. We bought it as part of a 50 house pack or whatever I think it was.
Yeah.
So, all right, well, let's, we're kind of wrapping up here on the questions that I have. I'm looking back through the notes here. How do you, from a differentiation standpoint, there's obviously other providers out there. There's obviously other real estate investors out there, you name it. So I'm always curious when I get somebody as high level as you, like what's your personal business's kind of like differentiation strategy that sets you apart from the crowd, from the crowd of other turnkey providers out there?
A couple of things. The first being that we're not married to any market. So most turnkey providers were rehabbers, and they've seen the light and have decided that this is a good business model, which it is. And they provide, part of their stock or all of their stock as turnkey, and they start selling it, right? They do the management, they do everything in house, which then there's nothing. I'm not saying there's anything wrong with that, but they're stuck in a market. So when the market moves and changes, it's not easy to pick up that system and move it somewhere. Where for me, it's easy, right? I can move from Boise, Idaho to Kansas City, Missouri, and I can do it in a day. Takes me no time, takes me no effort. The market shifts, I shift. That allows me to be in multiple markets and serve my clients better than I could and I have thought about it many times, because I'm leaving a lot of money on the table, right? If I went and actually did this myself, eliminate the middleman, right? Which some people think I am. If I eliminate the other end of this or become the other end, go end to end, there's a lot more money in it for me. But then I'm capped to one market. I can't serve my clients the same way. So that's the first thing. We're not married to any market. I've also built this software program that allows me to serve my clients better and on a deeper level. And it continues to get better. So not only does that software that I was talking to you guys about, where you load it up on your end, it's an end-to-end software platform that we built in-house. And on the back side of this, our clients have a portal. In the portal, it stores all of their real estate that they purchase. In addition to that, we've built a balance sheet for them where they can put all of their assets in there, and they can track how their assets are doing. That way, if there's a dog in the mix, they can get rid of the dog and replace it with something that's going to work good. And they can actually track it, because most people don't do that, right? They just buy stuff and put it on autopilot. In addition, we communicate with them through there, and we're constantly adding more and more things to serve them through this platform that we have, that we've built. And it's just kind of it's a unique thing where we can pro forma out real estate and show them what their assets can really be doing for them in a way that's unique to them, based on where their assets are. Because I think everybody on here knows that IRA assets are invested differently than cash assets and things like that. So it's more of a wealth management, wealth planning type of an atmosphere, as opposed to just selling a one-off rental property.
Gotcha. Yeah, that's something to, like we hear passive income and we think that, but like if you don't at least manage it a little bit, it's something that can really bite you. And that, you may even, we were talking about this in our mastermind a couple of weeks ago, you may end up even selling properties that are performing that don't feel like they are, because you have other underperforming properties that are like sucking all your cash out.
When you may be able to make a really simple change that can make everything perform, but how would you know if you're not tracking? One property is causing, it's like a thorn in your side, and ultimately you just go, well, screw this real estate deal. It doesn't work. I don't like it. And it's because of one property, where if you just changed one little thing, all of a sudden everything could be going really well. But how would you know if you can't see it? Like I'm a visual guy. I have to be able to see what's going on. If I can't see it, it just as well be lost. Like I don't know what's going on. So we made this very visually appealing so people could actually look at it and see very quickly, here's what's happening, Anyway.
That's awesome. So, all right, guys. So I'm going to, if you can talk, just unmute yourself and ask a question. And if you guys don't have any, we'll end a couple minutes early. It's up to you guys to take advantage of this time that we have with Ron. Ron, thanks for sharing, man. I appreciate you, man.
My pleasure. My pleasure. Hopefully it was helpful for some people.
Absolutely. I know.
I've taken rough work. I got to sit here in my home office and talk to people about real estate. It's pretty tough duty.
I got like 3 pages worth of notes. I've been like clacking away on my keyboard the whole time we've been talking.
Oh, good.
All right. Does anybody have any notes or questions on it?
I do, Jim.
Yeah, go ahead, buddy.
Hey, first of all, thanks, Ron, so much for giving us some of your time. I know your time is precious. We appreciate this. Has been excellent. I've definitely listened to this multiple times. Question, just to reiterate the point, have you ever bought a house close to retail because it was in a cash flow in a high rental area?
I buy everything that I buy based on the underlying financials. I'm less concerned. I mean, obviously, if you can get it for a great deal, that's fine, right? But let's go back a few years, because retail today is different than retail was a few years ago. And if I ask you today if you would have bought at retail price in 2014, would you do it?
Being that I'm a novice, I would probably say no, because I don't know.
Yeah, see, if I actually showed you if I pulled up the graph right now and I ask you and let's put it in 2012, because 2012 is actually the bottom of the market. Everybody thinks it was 2008 or 9 maybe, but it's not. It's actually 2012. So if you bought in 2012 to 2014, you bought almost at the bottom of the market. But would you have paid retail then?
No, I wouldn't have wanted to. No.
Yeah, see, I would. I'd pay retail at the bottom of the market all day long. And twice on Sunday, because the bottom of the market, A, it was an artificial bottom number, but B, the numbers worked incredibly. I mean, you could have bought like we were just saying, like Jim and I were just saying, we should have bought every single thing we could buy and kept it all. Because if we kept it all, not only would we be cash flowing an insane amount of money during the past 8 years, but during that time, our properties would have almost doubled in value, right? So everything we would have bought would have doubled in value. And that's easy to see when it's at the bottom of the market. And it's clear because we can go back in time. When you get close to the top of the market, you have to be a little bit more judicious about what you're doing. But everything I do is based on cash flow. Because again, I don't have the same machine you have. If you have a machine, Bryant, and you can buy stuff at 70 cents on the dollar, why would you ever pay retail? I wouldn't. But I don't have that machine built. So when I buy my properties, I try to buy under market value, and I'm able to do that only because I buy packages of houses. You know, people bring me a package of house, they're not going to get retail on a package of houses. So I'm able to negotiate that down. But I don't have a marketing machine built like you guys do. I used to back in the day when I was working in Kansas City, but I don't have that anymore. And so when I buy my properties, I buy them 100% based on what my cash on cash return is going to be. That's really the only thing I care about.
Awesome. Thank you so much, Ron. That was very helpful. Thank you.
Yeah. That said, don't do that if you don't have to. If you can buy something at 60 cents on the dollar, then do that. Right. But it's all relative to the market conditions.
Well, and you're earning, and the thing that I think Ron's getting at too is yeah, you're buying it at 60 cents on the dollar, but you're earning that. That's your widget. That's what you're spending your time, your effort, marketing resources into getting, rather than at the end of the day, just being able to say, okay, is this a good deal or bad deal? Okay, boom, all the time, all the effort, you name it.
And that's what everybody does in the BRR or whatever the hell it is, right? When you refinance your money out, you've in effect taken the money out of your widget, like Jim was just saying, put it in your business, and then you personally have kept a property basically at retail. That's in effect what you've done, right? So the difference is I don't have the business that sold the widget, but I'm in the property the same amount of money you are with debt. It's the exact same thing, right? You just pulled your widget money out of your business because you worked hard to get that property at a lower value. I just didn't do the work. My money is coming from the work that I do, which I'm really, really good at, like you're good at yours. It's just a completely different way of looking at things and separating out your business. And most investors, in air quotes, don't do that. They don't separate their business out, right? And that's what Jim was saying. You in essence, when you keep that property, you're paying yourself out, but yourself is your company, right? Your company that did all that work, spent the marketing dollars, did all the stuff, it gets paid the money. And then you keep a property that's basically you bought at retail.
So so what's interesting is I think like when I first started out, I mean, it's sexy. You take down a $30,000 check, from a flip. That's sexy. $100 a month or $150 a month, like short term. Oh man, that's not very sexy, right? Like on an asset. And what's crazy is if you look at the scope of your next 30 years of your career, I don't have a figure for this. I'd be interested in Ron's opinion, but I mean, it's probably 40 or 50 times more long-term wealth, like a more profitable niche to be in buy and hold, like over the course of your lifetime to like really nail that and build an asset portfolio. It's not even close to the amount of wealth and how profitable flipping is versus rentals. It's not even close. Now, you have to have the income to support it, right? But go ahead.
It's nowhere near as sexy, and that is why when you go to RIA meetings, there's nobody selling how to do turnkey properties. It's really, really difficult, and I've been presenting this for years. I know it's not as sexy because it's hard to get people in a room. When I'm competing with in 4 hours a week, you can make $50,000 a month. Where in rental property, you can't do that. Plus, you have to have money to do it, right? So it's really difficult. But I can tell you this. If you compare my net worth from my real estate holdings to my net worth that I've built through my business, the sexy piece of what I do, it's not even comparable. It's not even close to comparable. Almost all of my wealth has come from my real estate holdings. Almost all of them. So, I mean, it's not even close. And had I done the same thing Jim just alluded to earlier, which was done this right from the beginning and not piss away all the money that I made on my, quick flip stuff, I would be at minimum, I would be 5 times as wealthy as I currently am. Minimum 5 times as wealthy. So I call it the quick hit of crack, right? That's flipping. That's flipping. Everybody knows crack's not healthy, so you got to get off the habit. And the only way off the habit is a healthy diet and some exercise, which nobody likes, but that's the reality of the situation, right?
Unless it's your widget to sell the
then that's fine because the quick hit actually turns into the healthy habit, right? So there's nothing wrong with whatever your business is producing income and producing revenue that you invest into long-term stuff, right? Just make sure you take a percentage of it, just like everybody's told you since you were a baby, and put it into what you know. You already know real estate, right? So just put it into what you know. Not all of it. You should spend some of it on yourself.
Hey, Ron, Jason Courtney here, man. How are you?
I'm great, man.
Great to finally get to hear what Ron actually does. I've been trying to figure out what you do for a year. Now I know.
You still don't know what I do, man. You're like, what the hell?
I'm still partially clueless, let me tell you. But, I'm sitting here and I'm thinking about, the slow dimes that you're talking about versus the quick nickels, right? And I'm a firm believer that wealth comes from ownership. I paid 95 to 100% of fair market value for everything I bought in 2015 and 16. I have over $1 million in equity in those properties today, right?
Yep.
So I'm a firm believer that wealth comes from ownership, not flipping. We did short sales for years, and that was a feeder for our flipping business. Made a ton of friggin' money, but I had to, it was only as good as my next deal.
Yep.
But I'm sitting here saying to myself, Ron is getting these turnkey deals from investors like Jim and Ryan and Three Doors. And there's probably a ton of people on this call right now, most of us, that should be buying these from you, right? And just building our own portfolio. Even though they're cash flowing a few $100s a month, they forget about the appreciation of the property, the depreciation, the tax benefits, and all these things. All of us should be on your list of buyers, in my opinion, right?
Well, Jason, I appreciate that, and I would love to help everybody out. One of the things that I didn't mention that you just did, I just don't want to overlook really quick, and that's the tax benefits for everybody on this call, which don't apply to the majority of the country. Real estate investors who spend almost all of their time, if not all of their business time in real estate, have zero cap on the write-off to their normal income for properties that they purchase. And you can do a cost segregation study and you can accelerate the depreciation. And right now there's bonus depreciation. You can write off so much money against all of the rest of your money that you make. It's not even fair what we are allowed to do. And if you're not buying and owning real estate for only for that reason alone, you're missing the boat because you're paying a massive amount in taxes that you shouldn't be. Sorry to cut you off. I didn't really touch on that, but there's humongous tax benefits in it for people who are in the real estate business because of that no cap. It's disgusting, guys, how much you can write off if you own real estate. So yes, Jason, everyone should be buying real estate, 100%. And if you can't get it on your own, or you can't get enough of it on your own, yeah, you should go to a supplier and get it for sure. Absolutely.
Now we're a little bit over time. I do have one more question that came in. Ron, can we do one last question with you, man?
Yep.
Appreciate you. So the buyers, kind of specifically before you were doing like the larger scale of things when you were kind of starting out. Like how you were kind of building that initial buyers list, like when you started out, how did you do that, or what were you doing?
How did I get the buyers list? Is that what you asked?
Yeah. How are you marketing to the buyers, or what were you doing to pick up those initial buyers?
So initially, I worked with a company that was doing it.
Okay.
Right. They were educating, and they didn't have any properties. So I supplied properties for them. That was the first way I did it. Secondarily to that, the way that I did it, and when I started over after my partner and I had a split in 2012, beginning of 2012, I started all over again with nobody, right? So I started everything over again. The way I built it was I created local meetup groups specific to rental properties, and I marketed. So same way you guys send out postcards or whatever, I sent out a little bit nicer postcards, and I got them to, that actually wasn't a postcard. It was actually a trifold. It was really nice. Anyway, I sent those out to people in areas where they would have the money to be able to invest. And I invited them to a meeting where I provided dinner. And then I would set up appointments with them after the fact and share with them what I could do for them. And it built really slow, right? But I was getting 5 to 6% off of everything I sold. Doesn't take very many deals to be able to have enough money to market more and build your business the same way you guys are building on the other side, right? And so you can very easily do something like that. I mean, Meetup changed the game because when I first started doing this in 2007, Meetup wasn't around, and I just had to send out mailers and get people, and it was very expensive to do that. But with the advent of Meetup, you can do it, and you can do it really, really easily. You can do it very cost effectively. You can find free meeting places. You can have small, Friday lunch groups with 5 to 6 people and go deep instead of going, big. So you're only really limited by your imagination about how to reach out and touch different people with the information.
Nice. No, that's great. Appreciate that, man. Ron, thank you, man. This has been great. I got like 3 pages of notes I've been clacking away as you've been talking.
That's awesome.
Okay, so for this particular show, go to doorstodeals.com/018. Again, that's doorstodeals.com/018. We have full show notes. We have the YouTube video replay. We have all sorts of great information on our website, so make sure that you check it out. So go out, live your purpose, and above all else, go after your dreams. Take care until next time. Thanks for tuning into this show. For more episodes and resources that will unlock Doors to Deals, check out our website, doorstodeals.com.